In the world of finance, oftentimes we're focused on the growth, the return on the investment. And while that all matters, a lot of successful investors, they miss the fact that it's all about how much you're going to keep. It's all about the net. And so today what I want to do is show you how so many Americans out there are saving in a way that they're inadvertently going to get taxed on the bigger number. When I ask families, do you want to get taxed on the seed or the harvest? Everybody says the seed, of course, because it's the smaller number. But the way that we're saving today, the way that we've been taught to save in 401ks and IRAs, our financial religion is to not pay taxes today. I'm going to show you today why that may not be the best approach. Keep it right here. Good day, everybody. Chris Heerlein here of Roth Financial and host of Wealth Radio on News Radio KLBJ and host of Retire Ready TV every Wednesday, 6 p.m. news hour on KXAN. That's News Channel 36 right here in Austin. If you like our video today, be sure and hit the subscribe button and give us a thumbs up. Okay, now it's time to talk about how saving tax on $186,000 means you're going to pay tax on $1.2 million. So our financial religion in this country is to not pay taxes today. That is why the majority of you watching this video right now, I know where the bulk of your wealth is. How do I know? Well, at Roth Financial, we get to see hundreds of portfolios every single year. And the majority of successful investors out there, many of you watching, the bulk of your wealth is in IRAs and 401ks. Why? Well, one, it's easy to save in a 401k because if you're interested in paying yourself, front-loading your future retirement, it comes right out of your paycheck. And every month it's coming out, maybe you're getting an employer match at your job, and it can stack up quick, it can add up quick. With your IRA, you may want to put money in an IRA outside your employer plan because when you put the money in, you get a tax deduction. When you put money in your 401k, if it's a traditional 401k, well, you're getting a tax deduction, and that is the way that we're wired. We love tax deductions. But here we are, 2023. Would you believe it if I told you that tax rates haven't been this low in this country in 40 years? So for all of Americans that are saving in IRAs and 401ks right now, yeah, you're getting a tax deduction, but you're getting a tax deduction at a time in history where taxes haven't been this low in 40 years. Now you got to ask yourself the next question. Could taxes be higher in the future? And if you're like me, I absolutely believe they could. So you got to ask yourself, do you want to pay tax on the seed or the harvest? Do you want to pay tax on the smaller number, or do you want to pay tax on the larger number? Everybody says the smaller number, of course. But the way that we've been taught and told to save in this country is to get a tax deduction today. So let me show you a case study of how a 35-year-old gets into the savings game and is setting himself up to be taxed on a much bigger number. Take a look at the screen. So here we got a saver at 35. You can see they're going to put $6,000 a year into their IRA. Now, that IRA is going to grow at 7% during the working years. So you can see $6,000 went in that first year at 7%. You got a $420 return. The ending balance that year is now $6,420. Now, this individual is going to hold this course for at least another 20 years. So now we go to 55. That balance that started with that first $6,000 deposit is now $247,000. They're still putting in $6,000 a year. The account is still growing at 7%. And that earnings on that year was $17,324. Now the ending balance is $270,000 and change. We fast forward another 10 years. Now the individual is 65. The balance is $569,000 and change. Still putting in $6,000 that year at a 7% return. The earnings on that was nearly $40,000. You can see they're $39,882. The ending balance, $615,000. And at 65, that's the year, in this example, the individual retires. So no longer is this individual going to be saving in the IRA. To save in an IRA, you have to have earned income. So generally when you retire, unless you have a side hustle, you're not putting money in your IRA anymore. So what's interesting is that over the years, from 35 to 65, this individual put in $186,000 over that period, over 30 years. Now, this is not an example today of compounded interest and the power of that. That's many other videos on our YouTube channel. What I'm trying to show you today is that the individual put $186,000 in. And throughout those years, every year that that contribution was made, it was tax deductible. So that individual, over that 30-year period, saved $37,200 in taxes over 30 years. That's not bad. Remember, we like tax deductions, right? So save $37,000 on $186,000 of deposits. Today, I'm using a 20% tax bracket. We're just going to keep it really simple. Now, what you're seeing here at 75 is that beginning balance is $848,000. And what's this $37,000 right here? This $37,060 is not a contribution. It's not a return on the investment. It's what's called a required minimum distribution. And this individual has to start taking money out of their IRA at age 73. For most retirees today, your required minimum distribution age is either 73 or under the new Secure Act law, it's going to be 75 for those you born 1960 or later. But the point of this is that when you save money in an IRA or a 401k, generally you're going to be forced to take money out. Now remember, because you've been saving every year in this thing and getting a tax deduction, when the money comes out, it's 100% taxable as income. And when the RMD kicks in, you're no longer in control of when you're going to report that income. The government is. So we look at this. In the retirement years, we're only given the accounts a 5% return because many investors may decide to go a little bit more conservative in retirement. So we're just being lean. So you can see the ending balance at 75 is $854,000. You can see at 85 what the balance is here at $822,000 and the ending balance of $808,000. So if we keep this going, if we look at the retirement balance at age 95, the total taxable amount over this person's lifetime, because remember, every dollar in this account, whether it's taken out through RMDs or whether it's left to your heirs, to friends, family, whomever, it's going to be 100% taxable. The only way it's not going to be taxable is if you leave it to a qualified 501c3, a charity. But most families, they're planning on leaving it to their kids, their heirs, family. So the total taxable amount of this IRA, if this individual lived to 95 and passed it on, is $1.23 million, right there on the screen. $1.231 million. The taxes due at a 20% tax rate on that balance, nearly $250,000. You see it right there, $246,000. Now see, if this money would have been saved in a Roth IRA, not a traditional IRA, a Roth IRA, how would this picture look different? Well, over that 35-year period, the money would have gone in $6,000 a year, growing at whatever rate of return that you could acquire. You put $186,000 in, and over that time, you did not get a tax deduction. That's the amount you would have paid, $37,000 in taxes. But this number has grown to $1.2 million over the retirement years. And now you're paying tax on the much bigger number, $246,000 in taxes due on the $1.2 million. So when I say, how does saving tax on $186,000 lead to paying tax on over $1.2 million, this is the IRA game. And as investors and retirees like you are waking up to this, you're going, whoa, whoa, whoa. The bulk of my wealth is in these IRAs and 401ks. I want to pay tax on the smaller number. Here's the best news. It's not too late. You have strategies out there where you can draw down on your IRA. You have strategies where you can convert your IRAs and 401ks to Roth IRAs. Now, when you do this, it's going to create taxes. Again, kind of counterintuitive, kind of outside of our financial religion. But one of the things that we do day in and day out in our office is we compose Roth conversion plans for successful families just like you. And by doing this, we can slowly begin converting. We can slowly begin getting those dollars out of the IRAs. And when we do that, that money will forever grow tax-free. It will forever be left to your heirs tax-free. And most importantly for you, the retiree, never will the government be able to knock on the door and say, you have to take a required minimum distribution. They're RMD free. That's the power of Roth. So whether you're 30, whether you're 50, or whether you're approaching your 70s, it's never too early to get in the Roth game. Here's how you do it. You're going to email me right now, retire@reapfinancial.com. Right there on the screen, retire@reapfinancial.com. And we're going to send you our Roth report right there on the screen. You can see it. We'll send it right on its way to your inbox, retire@reapfinancial.com. Until we see you again, all the best.